Hello and welcome to the launch of ETBFSI.com and ETBFSI CXO Conclave 2019 powered by Automation Anywhere. ETBFSI.com, a news portal by the Economic Times with the aim of providing cutting-edge insights from the world of financial services to decision makers and influencers in the BFSI sector, was launched in a grand fashion by Maharashtra's Minister of State for Home, Rural, Finance and Planning, Deepak Kesarkar.
Sorry, moment. ETBFSI.com, the launch.
The mega gathering was attended by more than 300 professionals from the BFSI sector, where eminent leaders from the BFSI sector came together to understand how India's CXOs are rebuilding the sector. First up, we bring you highlights from Venugopal, Director Security Engineering of Checkpoint Software Technologies, on the topic Cybersecurity in the Era of Digital Banking.
All of you have heard of this particular case, right? A big heist from the ABN AMRO Bank. A classic case of social engineering. There was nobody who had to hack into somebody's system to actually go and steal money or the gems. What's happening now is slightly different. All this is in the news all the time, right? So you're seeing the different attacks that are in the news all the time. And here, we don't know who is doing it. You had a case where you knew who was actually behind the theft when it was a physical theft. But in these days, you really don't know who the threat actors are and how they are getting into systems and how they are siphoning off the money. All of us have super solid security at our network and perimeter level. Everybody, right? Whether you have it or not, you're ensuring that you have methods and processes in place that if there is an attack, it is stopped at one particular point and it does not really cause a damage. But then modus operandi of the hackers, what are they looking at beyond your networks? Clearly, people have seen that there are backdoors that are open to an organization. And one of them is your mobile banking applications. Or it could be a mobile device of a user. The user could be a consumer or a customer of the bank, or the user could be a bank employee. And that's a great way to cause harm to the reputation and also to make money in the process. There is also a need to look at cloud security. Right? What are you going to do if you're going to put an app which has an open API for others to consume? That needs certain level of security. So is that security going to be covered by the bank? Is it the bank responsibility? Is it the cloud service provider's responsibility? Or is it the user's responsibility when he or she is going to download or call those apps? People are trying to circumvent the fact that there is a strong network security. Let's try to move past that and see how we can enter an organization or attack an individual consumer.
Next up, we bring you highlights from the speech of Automation Anywhere's Gary Conway, where he spoke about the future of the BFSI sector in the digital era.
When you have digital native companies that have been able to actually create and fulfill demand on demand, and you mix that with digital native customers that are so used to working with technology, they know nothing else. We have created a I have to have it now economy. That's the world we live in, and it affects every business in any part of the world. So the big question that we ask ourselves is, why after 20 years of automation technologies, the majority of business processes are still manual? Why is that?
We now shift gears and bring you a glimpse of a fireside chat on creating banking experiences that fulfill the needs of millennial employees and corporates.
Mr. Purohit, my question to you, sir, is how are you going to build a bank for the millennials?
So if I talk from the banking point of view, we need to ensure that our banking apps are, first of all, integrated with their app. Because that's what they're looking out. They won't come to the banking app, they want their app. So when I say their app, like corporate customer have ERP as their app, these millennials have Snapchats or WhatsApp or Facebook. Their experience would be that they want banking eventually to be integrated with them so that they don't have to go to the banking application for carrying that piece out. Expectation is also that they will say, okay, transfer this money from my X account to Y account or show me my balance. That's a conversational banking. So that's also something, the expectation which they have. And I'm sure the customer experience as a theme in our country is at the nation stage. If you ask me, probably we have reached the 20%, and probably it will take another 3 years for us to reach the maturity what we talk about when customer experience is required, either by corporates or by by millennials.
Great insights, Mr. Purohit. So now, Mr. Ganpati, I will take your view on every bank, every financial institution is adopting data. And the important strategy that they want to develop their bank is specifically around data. What are the major challenges financial institutions are facing when they're forming their data strategy?
So if you look at most of our environments today, you will find that there are data silos, there are infrastructure silos, and there are process and policy silos as well. And that today is the biggest challenge because our growth of adopting or technology becoming inherent to the function of a bank has been organic, and growth organically brings across its own challenges that you are living with legacy data structures, you're living with legacy infrastructure architectures, and you are living with legacy processes, policies, and the way of doing things. The biggest challenge I see most banks going through and slowly transforming is in trying to unshackle this legacy that they are carrying.
Next up, highlights from a panel discussion where tech leaders discussed opportunities and challenges currently facing the world of fintech.
I think I'll bounce the first question to all the panel members and request them to share their experience, their knowledge, their use cases, what they have done in the form of disruptive technology that they have noticed in the past couple of years in their sector, and what have they implemented out of that in their organizations, which will help all of us to understand as to what technology can deliver and what are the benefits of those technologies that have been worked. So I think I'll start with Guru Raj.
In this scenario, the search for technologies which will add direct benefit to the businesses is relentless. So we do have a culture of experimentation as well. And for example, blockchain is being used for the supply chain financing across various OEMs and various suppliers of the automobile sector. For RPA is being done for the processes where automation is the only choice, because we believe that RPA has to be used in the right places. First of all, you have to ensure that the processes are optimized, and then get into seeing whether automation is the only solution or the best solution, and then get into the right tool for that. So we have selected a few processes and implemented them successfully. With regard to the implementation of analytics, we have been able to do it in the areas of credit ratings, in terms of collections, collection efforts, because more than 65% of our collections even today is in cash, and it is done through physical interaction through our employee force. So there is a lot of potential that exists with regard to handling this very efficiently, and that's where we have focused our attention with regard to the analytics. But we believe a lot of potential exists in these technologies, in these projects, and that's how we have been able to implement them.
Can we hear from you on your sector? What actually have you done, and how has technology helped your sector and your company in particular?
I would just like to share a use case, a real use case when people are talking about digital and the disruption in the market. So we have really done it. When we launched Dhani, it's a personal loan application, and when we used to have this Aadhaar-based authentication and eKYC, we were able to, disburse a loan in 3 minutes in your bank account directly. So the business which used to happen a 9 to 5, 5 days a week, it has become a 24/7/365 business. So that's what digital can do.
Now let me come to the next illustrious panelist. What has the technology actually helped you, or how it has helped you in your industry?
So big data has been the biggest use case, but even that is now getting augmented by alternate data, operational data, data on the move. So now data is getting broken up into 2 parts. So you have data at rest and data at flow. So now the technology disruption is more about how can you in flight have quality, how can you use machine language to score, how can you API, containerize, and move it fast for the whole digital economy.
So what are your thoughts on that?
Last 4 years, what the things which has changed, or rather has challenged us, though being the new bank, is that the kind of partnerships business is expecting, and many more businesses are expecting, that is actually keeping a lot of pressure on IT. So first we started our bank with completely SOA as an architecture, then transformed that into API, and now I think, we are getting into the microservices architecture.
Sunit, coming to you, you are one of the big distributors of credit cards. Though you don't, I can't say you are a bank on your own, but you are a subsidiary of a bank, and you're distributing credit cards and servicing credit card customers in a big way. So what are the challenges, and how has technology actually helped your industry to take care of it, and what has your company done to adopt these technologies?
The kind of disruption we've seen from technology point of view, right? And what does disruption means, right? Disruption means either you are bringing a newer platform or a technology which allows you to replace someone with older technology was doing, or you're able to create a new business line. That's the way you create the entire disruption in the market. So the trends we have seen over the last few years where we are learning from and constantly improving on is fewer trends. Example, serverless computing. And how we implemented this in last 18 months, we not bought even one server. It means totally we are running on cloud, or we are doing on an OpEx-based model, on a service-based model, but we are not investing even a single rupee on a CapEx-based servers.
So how is this backbone of technology constantly upgrading and helping the users to achieve what they actually want to achieve through the technology that they would like to use?
Look at some of the changes that we have seen over the years, especially touching upon on the banking sector. Mobility, telecom, and banking goes hand in hand. We all look at about mobile banking. Now look at the infrastructure. Am I able to access on real time at any point of time? You always have a problem. You go to the basement of the building, you don't get the connectivity. So how am I making sure am I getting connected always? Is the infrastructure built out to suit your in-building wireless systems? We are talking about 5G upcoming. It's going to be really dense. It might not be implemented today, but I can tell you Asia would be the first in going a big time on the 5G is.
Manish, coming to your sector, how are you using technology, and how is your thing going on as far as the disruptions are concerned?
So what we realized when we are working with variety of customers is that any organization is as disruptive as the amount of disruptive talent it carries, right? Every customer today is talking speed. And when you want to move with speed, you need quality engineering, which is more or less automated, you know. It is like a self-driving car kind of philosophy. Or whether you're looking at shadowing every single customer for their experience, you know.
We got to shift our dialogue to be very customer-centric. As we know that a lot of fintechs, why they're successful, if you ask the founder of this fintech company, they're remarkably customer-centric. They're obsessive about customer problem. I think banks historically are not really customer-centric. They're very product-centric.
I think as banks, we have to reimagine the whole customer behavior and the whole customer experience. So today we are seeing a customer completely wanting instant gratification, literally 2 or 3 clicks, and the customer wants to be done with his banking services. And second is the way banks are working is about hyper-personalization. So clearly, a customer doesn't want a general suite of products that from a bank that this is my products and this is what I'm offering you. It's about a customer's needs and being customizing for that.
Welcome back to the launch of ETBFSI.com and ETBFSI CXO Conclave 2019, powered by Automation Anywhere. We now present you with a short glimpse from VM Software Sandeep Bhambure's speech.
Well, you all know, of all the challenges, one of the biggest challenges that this industry faces is around customer expectations, right? And the reason this is important is because customers' expectations are changing, okay? They are changing in a big way, and the IT, underneath IT is is a big medium to deliver on the expectations. If the IT is not highly available or available always 24/7/365, somewhere you're going to fall short on the expectations. When you have your most critical of applications and your business so dependent on IT, and you're not able to deliver on the availability, if the application goes down, it's definitely going to impact not only your business in terms of revenue, but also in terms of the customer expectations.
Finally, we present you with the highlights from a panel where eminent leaders came together to discuss the challenges and opportunities currently facing non-banking financial companies in India.
So we'll start with Mr. Umesh Ravenkar to tell us as to what the scene is. Is it really as bad as is being projected, or is it that just a bit of a stress is being exaggerated into a kind of a full-blown crisis?
Everyone was focusing on their asset side, their ability to onboard, lend, and collect better, and understand the customer segment better. The liability side, understanding of liability side was something missing. There was not much broad-based. Maybe they focused only on some of them wholesale or too much dependent on bank. I think that is creating some kind of anxiety. If the NBFCs balance their liability side well, I think there is enough scope and opportunity for NBFCs to grow their business, is what I believe.
So I was talking about the liability side. Is it that the entire industry is doing the same thing, or is that you can differentiate between the good ones and the bad ones?
It's really not as bad as it is made out to be. So the headlines are fairly negative, but the reality is not that bad. Every few months, if one source of liquidity is receding or drying up, another source of liquidity comes in. For example, PSU banks, when in PCA, we saw an influx from private sector banks. Now, if the capital markets are a little tentative, the PSU banks are back, and we have another source, which is overseas loans. So my quick comment is, no, the situation is not that bad. Money is available, probably at a slightly higher rate. So the questions to ask are we able to react quickly and transmit higher cost of funds to consumers? If it's a yes or a maybe, then the situation is fairly okay.
From an industry point of view, what is that you are seeking from the regulator?
You know, if we look at the way regulatory structure was evolved, while at the beginning in 1997, it began with the total focus on liability side, the deposit side. Slowly, it evolved and moved towards totally concentrated on the asset side. As a result, the fundraising avenues got restricted. You know, there are issues with the securitization guidelines. And of course, capital markets is something which you cannot expect a very large number of small and medium enterprises to access. Coming to the point, what we are seeking, which is important. As an immediate point, there are two perspectives. One is that, you know, for the larger number of the big companies, as to say, obviously we need to look at ways beyond the traditional way of bank funding NBFCs. And of course, securitization by way of bilateral assignments has been a very favored tool. There today, we see a bottleneck. In the securitization guidelines, I think, and that's what we've taken one of the key issues as an industry body, that the entire concept of minimum holding period, the MHP and MRR, I think have lived out their life. Because why it all started? It started off with the concept of on-tap securitization, which happened sometime back when these guidelines were brought in. But in today's scenario, when banks are doing cherry picking and picking the cream of my portfolio, to imagine a bank going for an on-tap securitization is paradise world. So I think the concept of MHP and MRR needs to be relooked, in fact, done away with, if you ask me.
I go to Malay, since you spoke about the restrictive securitization rules. Is that good enough to really solve the funding problems for the NBFCs?
My perspective is that NBFCs were growing so much faster than banks. NBFCs were borrowing from banks. They were growing 25% plus, which was way fast for someone to grow in an economy that's growing at 13% nominal. So even if you were to sort of give 1.5 times multiple, to the nominal GDP growth, NBFCs, a modest and a good growth for them should have been 20%. So on the face of it, most NBFCs were growing too fast. That's the first perception that we have in these stock markets.
So we have to understand this problem that this NBFC crisis is because of that NBFCs were lending for long term and they were borrowing for shorter term tenor. Shorter term can be from banks for 2 to 3 years or from mutual funds. I would also like to add, like panelists have said that NBFCs can manage this crisis by managing growth. But you have to take into account two factors. NBFCs had built a cost structure for a certain kind of growth. So if you don't grow, that cost structure, high cost structure, will hit NBFCs at certain point of time. Secondly, if there is a liquidity crisis in market, the end customer can start showing higher NPAs. We had seen that particular stuff when PCA restriction came in, that there were SMEs who overnight lost their credit limits and were not able to grow. And at the end of the day, some SMEs went bankrupt because of liquidity restriction.
So what is that you are looking to from the RBI when they come up with the new set of rules?
For smaller NBFCs, the problem of liquidity has not really hit at all. The only impact is that the interest rates have gone up. There's been a 50 to 70 basis points increase. And that is something that a lot of smaller NBFCs can pass on to the customer or absorb. What is good growth? NBFCs have been growing their book by 15 to 19%. Is that really bad? Is the growth that banks have shown at 7 and 8% shown better in NPAs? I think the answer is contrary. So it's not the 15% growth that the NBFCs have seen is the culprit. I think NBFCs have in their DNA have been the sort of company that have worked on the fringes of whatever the banks left, and they've used their smartness to provide funding to people which banks would probably not have done. And they've done it well. They've done it so well that their NPAs in general have been lower than the banks.
You're the one with a P2P platform, and is this the kind of a right opportune time for someone like you, P2P?
A peer-to-peer lending platform is a new class of NBFC recognized by Reserve Bank of India in October 2017. And as of the moment, this industry is growing with 3 digits because it is in nascent stage. And this crisis, we are feeling that these are course correction, temporary course correction. So there is enough market for everyone, and being in a nascent stage, P2P will grow much faster, but it will coexist with other sort of financing.
Digital space, as you call it, is like a tsunami. No, nobody in this ecosystem or space has an option but not to adopt it. And I'm very happy that our regulator is very keen on that. They're looking at, there are a lot of committees going on right now. They're looking at sandbox environment. They're looking at digital regulations coming into place. Some has already come into place. So I think they're also adopting to it very fast, and I'm very excited about the new regulations which would come through to allow us the flexibility to move at a very high speed.
There is a lot of innovation which fintech companies are doing, especially on consumer adoption and consumer interface and consumer delight. So whereas the bank continues to be the custodian of the customer as well as the custodian of the money which a customer actually delivers. So partnership between the fintech and a bank is the right model in which you can take that journey forward and give a very good experience at a very safe and secure manner through a banking ecosystem and through a fintech partnership.
Regulators in India have been quite accommodative on new technologies. If you notice, whether it's P2P lending or any other new areas which are emerging, they've allowed the innovation to happen. They've allowed new ideas to stem in or to come in. And when they feel that the market is such where scale is going to increase, they've brought in the right regulations. So they've not curtailed innovation by bringing in difficult regulations upfront, but allowed innovations to prosper and then brought in regulations so that it doesn't go out of hand.
The launch of ETBFSI.com and ETBFSI CXO Conclave was a grand success, and the mega gathering ended on a high note, charting a roadmap for the BFSI sector on tackling the challenges presented by the digital revolution.